Hello and welcome to our March Newsroom. I'm here with Rob Gill from Altura Finance. Rob, good morning. How are you today?
Good morning. I'm very well, thanks. Nice to be here.
I wanted to do an introduction. Tell us a little bit of where you work and what it is that you do.
Sure. So I'm the Managing Director of Altura Mortgage Finance. We are a UK mortgage brokers. We service the UK market, a lot of UK buyers and remortgage borrowers and buy-to-let investors. We also look after expats, probably around 10% of our business. So we have a broad range of services that we can offer people who are looking for finance and all sorts of properties from all sorts of countries in the world.
Good, fantastic. I've heard your name a couple of times here in the office because we do work with a lot of expats, investors, a lot of clients based in Hong Kong, and I think you might have potentially have helped some in the past through Freddie, who's based in Hong Kong. I think that's how sort of it came about to meet today. And we also have clients in South Africa, which I don't think we've had the pleasure to kind of make introductions. I'm sure it will happen. I've noticed that you started in 2019, beginning of 2019, and towards the end of the year, Christmas time, I started hearing about what was going on in China with COVID and everything, and flipped the year into 2020, and we get hit by COVID. So starting in a new company, 1 year in, and obviously dealing with mortgages and everything, and having the experience of going through COVID, working from home, tell us a little bit about that. How was the change of a new venture and then COVID?
Definitely an interesting time. I was actually in Hong Kong at the back end of 2019 in December on one of our marketing trips. We were at the Carbine Club lunch, which is quite a well-known institution, and people were talking about the protests in Hong Kong. There wasn't much talk of a pandemic at all, if any, but there was a lot of turmoil anyway out there. So come back to London, and then probably around February, people started talking about this thing called coronavirus, as we used to call it then. And obviously in March, almost exactly 3 years ago, now the world changed completely. We were quite lucky in that at the time we were relatively small. There were only 3 of us in the business. We were about to take an office in early 2020. Fortunately, we didn't. We sort of held up, kept our powder dry, a little bit because of what was going on in Hong Kong. We just thought, let's see how that settles down before we commit to this expense. And then obviously it became very redundant. So I'd been used to working from home. I had a sort of hot desk pass to a WeWork style place in North London that I'd use. It was not too far from my son's school. But other than that, I was home at least 3-4 days a week when I wasn't seeing clients. So for me, the big change was not that I was working from home, but suddenly so were the rest of my family. So it was a busy house. I was able, because of the position the business was in, to be flexible, to help my kids out with their schooling and then work as I needed to. And I think most people in the mortgage market thought, well, this is it. The property market is going to die a death. No one can view houses. No one can go to offices. It's over. Then obviously the stamp duty holiday came into effect in June of that year, and it sort of picked up hugely. So most mortgage brokers and most property people, I'm sure you were the same here, had record years, sort of 2020, 2021. The market was very, very busy. So it's worked out quite nicely for us. I think we managed to really form our business model around this remote working, which is great for us. It's great for most of our advisors. It allows us maybe to recruit more experienced advisors to a model where they can work from home, they can work around their families, they can work where they want to, where their clients are. Got all sorts of different types of advisors in terms of their family situations and the businesses that they want to run or how they want to work. So that means that they can do. And now we've settled into a pattern. We have a different WeWork style office in Liverpool Street, which is very nice. I go there 2 or 3 days a week. I'm going there after I'm here today. And the rest of the time I can be at home so I can work around my family. Good mix of seeing my kids at breakfast, doing school runs when I need to, and being in an office in a busy environment in the city when I want to as well.
I think that that's the silver lining, I would say, from COVID, is that we've learned to work from home or remotely, from whatever it may be, and maybe balance life a little bit more with family. And I can see that coming across as well, even with the spring budget. Now, this change in terms of childcare, me as a female having 2 kids, I went through this stage of, oh, do I go back to work or do I stay home with the kids? So I stayed with the kids. So that means I take a step back from my career and get a certain compromise, getting back into it and settling up again and getting up to speed with everything. So I think it's a good silver lining from COVID that we've learned all this, how to balance things a little bit better. And even in economy, you can see there's adjustments to allow more people to work, from home, and also wraparound care is also important. So it's nice to see this happening now. I was going to ask you as well, whilst you were in the middle of the pandemic, there was a bit of an exodus from London. I had a lot of friends leaving smaller flats and buying outside, remortgaging, refinancing. Tell us a little bit about your experience on that side. What did you see happening more? Fresh mortgages from scratch, remortgaging. How was it from your side in terms of
It's an interesting question. I think possibly because of our geographic location, we do largely service clients in London. I do have clients based outside London as well, in the home counties, the kind of places where people might have moved to. I don't think we saw a huge exodus from London. I could possibly use myself as an example. We had a 3-bedroom house in North London in Zone 2. We were very comfortable there, but it was getting a bit small. We toyed with the idea of leaving London, but actually we just thought, well, we like the fact that we're 20-25 minutes commute from central London, especially working in the city as I did. But given that we're now only going in 2 days a week and we don't have to go in during rush hour anymore, that doesn't matter, but actually we don't need to leave London. We'll move to Zone 3 or Zone 4. So that's what we did. We bought a bigger place, a 5-bedroom place, just by moving up the road, literally about 1.5 miles. And I've seen more of that than I have people actually leaving London. People have thought about it and thought, well, we can get more for our money just by moving a little bit further out, which really suits us now because we don't have to commute every day. It's 1, 2, 3 days a week. Some of my friends don't go in at all anymore. They've built an office in their new big back garden so they can work from home virtually all the time. That's the compromise. That's what we're seeing more of. I used to live in an area of London called Finsbury Park. We've moved to sort of Highgate, Crouch End borders, and we have a lot of clients in Crouch End, Highgate, Marswell Hill, those sorts of areas. So you're not quite on the tube anymore in certain parts of those areas. You're swapping Zone 2 for Zone 3, but that works. You get more for your money out there, and you don't need to commute every day anymore.
No, that's good. That's brilliant. In terms of the clients you work with, expats, because obviously we're talking about clients that already live here in the UK, but it seems like you have a lot of clients from abroad, especially in Hong Kong. What changes have you seen in terms of the clients buying in the UK through the pandemic and until now?
Towards the end of the year, there was definitely a flurry of interest in buying in the UK. You had a double whammy if you were buying from overseas. You had a weakening currency and a weakening property market. So it was a great time for people to take advantage. So we definitely saw more of an interest, and that sort of carried through. Initially, it's inquiries, people looking at the maths thinking, wow, this is a good idea. We know property takes a while to sort of get into. It's no liquid acid, as we call it. But the interest was there towards the end of the year, and then started to translate into sales. Another big trend that we've seen is people remortgaging their homes. If you did move abroad for, say, 2 or 3 years, typically what you can do if you get offered that position overseas and you've got a home here is your lender will give you what's called permission to let. So you say, I've been offered this job, I need to move fairly quickly, I haven't got time to sell my home, or I don't want to because I might come back in 2 or 3 years' time. In fact, that's my intention at the moment. And they'll allow you to keep the same mortgage in place on a permission to let basis. That typically lapses after 2 or 3 years. So given where Altura is in our cycle, just over 4 years old, we start to see clients reach the end of that and come to us for remortgages onto buy-to-lets. So that's a lot of what we're doing at the moment. A lot of the lenders have picked up on this, started offering low or zero fees. I had one go through recently that had no valuation fee, which is quite unusual for an expat product. That was last week. So that's a big part of what we do. People come into us saying, I want or I need to remortgage this property because I've now realised I'm not coming back to the UK. My lender is insisting I remortgage, or I want to do it because it's the right thing. Maybe want to take some money out because I've got some good equity in that property and I want to buy somewhere where I live. I did a mortgage for someone recently who had been sent to Paris after Brexit, realised it was long term. I was buying somewhere in Paris. So we remortgaged his London home that I'd hoped to buy just before Brexit, ironically. Take some money out, buy the apartment in Paris. So we're doing a lot of that sort of restructuring for clients who are now wanting to put down roots in Hong Kong, Paris, Singapore, Dubai, wherever it might be.
It's really great that you've mentioned that, because I think a lot of clients don't realize that potentially they can change their mortgage from buy to live into renting. I wanted, if possible, for you to give us a little highlight of how can someone do that, and for clients to know that they can do that. We've had someone locally who had 2 properties, bought one with the thought of, okay, we're gonna rent it, a bigger place, more bedrooms and a garden. but they didn't get the right mortgage. So then they come to realize, okay, actually we can't rent it. So what they had to do is they had to move from the other flat they had, because that one they could change, and they had to move into that bigger place, live there for a certain amount of time, and now they're going back to the original so they can rent the first one. So to avoid clients from doing this kind of maybe innocent mistake, because it comes down to knowledge and not knowing, give us a little bit of advice on that. What can clients do and what they should look out for if they do plan to buy with the intent of renting?
Okay, so the first thing to be very clear about is that, as I said earlier on, most lenders will allow you permission to let if you're moving out of your property for a period of time. The two main reasons that happen is because people move overseas or they're moving with a partner. So it's maybe not relevant here, but lenders are very used to and very flexible. So you don't need to do this immediately. You can sort of take your time and work out what's right for you. Contact your lender, ask for permission to let. As long as you've had the mortgage in place for 6 months or longer, then they're usually okay with this. I have a client who I did a mortgage for probably 10 years ago, and he's still got permission to let. He's just moved back to the UK. So for him, that's worked out really well. That just kept things really flexible for him. And as you say, it's sort of buying some time. It's not rushing into something.
And in terms of rates, how does that get?
Well, you keep the same rate if you do that. So again, if you secured a 5-year fix, say a year or so ago, which would be at a very good rate, you don't want to give that up. You'd have penalties for doing so. So getting permission to let in that circumstance is a great solution to allow someone to go and do what they need to do without disrupting their mortgage, without disrupting the great fixed rate that they've got, or paying penalties, and allowing them some time to work out what they really want to do.
I've also heard about bridging. I have clients who suddenly decided they had 1 or 2 in the portfolio, and they said, "Oh, I'm bridging now." So I'm like, what exactly? I'm obviously not very familiar with it. It seems quite complex. So are you able to give us an idea of what bridging is, and is it the best thing to do? Is it then another option? Because I've heard as well, oh, maybe that should be what I should have done. Maybe there was a better way of releasing equity and buying elsewhere, or developing a portfolio. So for clients who do have more than 2 units going in for their third, what would you say in terms of bridging or other options that they have?
So bridging is short-term finance. The original method behind bridging was exactly that. Someone couldn't sell a property and needed to buy another one, so they'd use it to bridge the gap. We might be, well, we can't sell this one just yet. We need it to be simultaneous to afford it. Take a bridging loan for, say, 3 to 6 months while that sale goes through, and then when it does, you pay it back. That's the original sort of meaning behind bridging. It's since evolved to be short-term finance that is often used by property investors and property developers, and it is short-term, and it is usually quite quick. It can be complex, but it'll also be very simple because the lenders are expecting to get their money back quite quickly. The other side of it is expensive. From that point of view, it rarely works out to be the best option. I get plenty of people coming to me saying, I want a bridging loan. You go through the process, explain it to them, explain the cost, and suddenly they don't want that bridging loan. You know, they decide that actually they've got more time than they thought they had. That first example that I mentioned, people using it as a natural bridge, probably 9 times out of 10 I have that conversation with someone, they manage to make the timing work. You know, they get the other party to wait a bit, or they sell quicker than they thought they were going to be. So it can be quick, it can be good, it can be flexible, but it's expensive. It is usually used by experienced property investors or developers who are doing one of 2 things. Buying quickly to get a deal, and they understand that if they're getting 5 or 10% of the property, it's worth using this as a short-term way of getting the property, knowing they'll remortgage it, but it still works out good for them. Or they're developing, so they're going to sell it. So, right, I want to buy this quickly, and I want to develop it quickly, and they'll sell it within 3 to 6 months, having done the renovations to uplift the property value, and then they pay it off. Which brings you on to the final important part about bridging. Usually it's on a cost per month basis. So it's interest charged per month, not annually, and it can be 1, even 1.5% per month. So it is expensive, and the quicker you can pay that back, if you're a developer, that means the quicker you can turn around the property to sell it, the less it's going to cost you and the more money you're going to make.
Someone who wants to act fairly quick, I'm trying to think about timelines between applying for finance through the regular methods of buying to rent. What is sort of the time a client should expect? Someone who's buying, let's say, off-plan versus someone who's buying a second-hand property. What is the timeline? Because with off-plan, obviously they need to leave a deposit, they need to put 10%, and then eventually once they do to complete, they need to come up with the remaining of the finance. what I tend to see sometimes is they leave it for very late. I would like to know, and I think for the clients to be aware, how how close should they get before they get it sorted? Because then obviously I see developers putting pressure because they bought a really good rate. They want to get away from that sale, and they put the pressure in the clients, which is why sometimes we get the bridge conversation coming across, because they waited too long to get their mortgage. So what would your advice be in terms of, okay, if you're buying, you need to complete in January next year, you should start preparing XYZ date before?
It's a very good question. It is a hard one to answer. Obviously, you get the other end as well, where developers will delay things for clients who are well prepared. So as a client, what do you do? I would suggest speak to a broker as soon as you're going to offer on the property. This property might not be ready for a year. It could be longer. It could be 2 years. But at least get an idea of what's possible now. You know, there's no point trying to buy a property if actually, under any circumstances, you're not going to get that mortgage. So have a conversation with the broker as you're going to put the offer in. Talk to them about your circumstances. They'll be able to tell you what's available now. You know, there's no guarantee that the lending environment won't change or that their own circumstances won't change, but at least you'll have done as much as you can. You can also have a conversation with them about the timing. So typically, you probably want to be applying for a mortgage between 6 to 9 months before completion. You can't do it too much before that, because most lenders, and I stress most, there are some who are a bit more flexible because they understand the time frames of new build property. Their mortgage offers don't last for more than 6 months.
That's what I was going to ask, because we have that perception 6 months. So people start thinking, okay, if I act 4 months before, I still have 2 months after if things go a little bit faster, if they slow down or get delayed or whatever it may be. Because we've had that as well. Someone buying, the process got delayed so much, they had to have another chat with the bank because it was about to expire. And obviously the rates that you get initially, it's probably not guaranteed that you're going to get the same thing once it has expired. In terms of rates, there's a lot of talk going about inflation, mortgage rates. We know they've been sort of coming down, and we just about dodged a recession, or, well, technically, at least for the time being. What are your views in terms of rates, how they've been coming down, what the government's been saying to keep them down and decrease them towards the end of the year? I actually wrote down on my board that they set to fall under 3% towards the end of the year compared to, the 6% that we've started off.
Sure. So we saw a big spike in mortgage rates after the mini budget last year. Mortgage rates have been rising anyway, sort of steadily from the end of 2021, but it was fairly steady. It was quick in one respect, that they were going up from sort of near zero to 3 or 4% base rate anyway, and that was having an impact on mortgage rates. So I guess mortgage rates are at the lowest they've ever been at the back end of 2021. You could secure a 5-year fix on a straightforward UK residential below 1%, which is extraordinary, and I did do for a few clients and friends who I suggest owe me a good few lunches now. And that went up to about 3.5% by September last year. On the aftermath of the mini budget, they almost doubled. 5-year fixed rates were north of 6% very, very quickly. Huge turmoil in the market. As I said to many people, there were a few days where UK mortgages were arguably the biggest story in the world, and that's not a good thing. And we saw that come through into mortgage availability, definitely mortgage pricing. The government fell, Truss went, Sunak replaced her with Jeremy Hunt, and mortgage rates started falling. And now we're broadly back to where we were before the mini budget. So really, we saw a steady rise, we saw a big spike, and we've seen them fall since, largely because we were undoing the damage done by the mini budget. So we're back where we started. What will happen now is interesting. Up until about a week or so ago, most people expected base rate to rise by 0.5% last week. Actually went up by 1/4 because of the turmoil we saw in the banking system, with SVB Bank failing in the US and Credit Suisse getting into trouble in Europe. So now people have started to think, well, this massive rise in interest rate rises around the world, regardless of the mini budget, has put the financial system under strain. The central banks might have to rethink. But then inflation is still stubborn. It was higher than expected last week. Everyone thought it would come down last week. I'll say everyone. The consensus was it would come down. It actually went up slightly. So I think the central banks are in a difficult position, and no one really knows what's going to happen next. But it seems like mortgage rates are fairly steady. They largely ignored the base rate hike last week, probably because they were pricing in a 0.5% and they only got a quarter. So that means they've stayed fairly steady. We look like we might even be entering a bit of a price war with mortgage lenders. It's like any sort of service or good. It isn't just about the raw cost, which in this case is roughly speaking base rate. It's about the competition. The supermarkets see the price of fruit and veg going up, but they're not selling enough. They won't just keep putting prices up. They'll try and cut them and possibly get into a price war. It's no different with the big organisations that are mortgage lenders. So at the moment, there's maybe some downward pressure as lenders feel we're going to a more challenging market. Mortgage approvals have been down quite a bit recently, and they need to keep the wheels spinning. They need market share. So we've got the other pressure that they need to cut rates to try and win market share and try and encourage people back to the mortgage market.
It's interesting that you say that it's obviously there's a bit of competition, which for me, I welcome it, because if there's competition, that means some prices will go down. I always had this vision of, okay, banks will stick together and keep the rates up. So it's refreshing to hear that there is that little budge there, and there'll be better deals for the clients. Would you dare to say, what are your predictions coming beginning of next year? I've met with someone in Dubai who works in the banking industry over there, and he was telling me, Susana, next year you'll see things are going to change. And his view was not exactly the most positive. Despite everything's going on here in the UK, he's obviously based in Dubai, and things over there are quite buoyant. There's a lot of money going there from, as we know, Ukraine, Russia, and whatnot. But I find it to be a bit volatile. So for him to be commenting in the UK, which is highly regulated, which I always found a safe place to invest, from your perspective and experience, being 15 years in the industry, as you've mentioned, into next year, March, what do you think it's going to be like in terms of, would you dare to predict or estimate?
I'd hope we're going to have a nice boring time between now and next March. That's what we all want, some stability and some boredom, please. And if we get that, I think things will settle down. Inflation is a problem at the moment, and the authorities are keeping a very close eye on it. But it is what I learned at school. It was called cost push inflation. It's about costs, and they're trying to counter that by retracting demand. But we're already seeing, when I fill up my car, it gets slightly cheaper every time. We know that utility bills are sort of steady and hopefully coming down. So hopefully that cost push inflation will settle down. The government have predicted that inflation will be at 3%, I think, by the end of the year. And if they're right, then that hugely relieves the pressure on the Bank of England to keep putting up interest rates. It's possible as well that if your contact in Dubai is right, without trying to second guess what he was saying, we're in an interesting situation at the moment that we may have dodged a recession, but we're certainly slowing down in terms of economic growth. And usually that would mean the Bank of England cutting interest rates, not putting them up quite dramatically. So if inflation does drop away, then maybe they'll have to reverse the direction and start cutting to relieve the pressures on the economy and try and get growth stimulated again. So I would hope if we have a relatively benign environment over the next 12 months, the interest rates are slightly lower. The property market is stabilised. I believe it's going to drop this year, but it will stabilise by the beginning of next year. We know that property shot up hugely during the pandemic for reasons we've already discussed, so we're going to give some of that back. But hopefully next year we've got some stability with property prices sort of back to rising steadily, and interest rates maybe a little bit lower than where they are now.
Having looked at mortgage rates, and there's still interest in investors putting money in the UK, what are the differences that you've seen so far in terms of requests for mortgages from those clients in Hong Kong and different countries? I know a lot of people have moved out of Hong Kong because of the restrictions, gone to Singapore, gone to Macau. Now they're restructuring again to go back to Hong Kong. In terms of investing in the UK, have you seen a bit more interest, or has it sort of stabilized because everything's trying to balance itself off? How is it from your side? Because I have questions from clients looking to buy, but it's a small portion. You obviously have access to so many more.
So we definitely saw a spike of interest towards the end of last year. As I mentioned, property prices were slightly softer and the exchange rate meant it was in their favour. So absolutely towards the end of last year we saw a spike in interest, but that translated to actual sales is still a bit too early to tell. Another big driver of the market for us, or started to come through, is B&O passport holders who may have moved here in the last year or two. We were positioning for some interest from them, but human nature is no one moves halfway across the world and immediately buys a home. Of course, you rent for a while. You've got enough going on. You want to try the area. You want to try the schools, all that sort of thing. So we're starting to see people who maybe moved here a year or two ago starting to inquire about buying their first home in the UK because they found the area that they want to settle in. They believe they're going to be here long term. So that's started to come through as well. A really important thing to mention is the effect of interest rate rises on how much you can borrow. So I'll try and keep this relatively simple because it can be quite technical. But banks have to use a stress test rate to work out how much you can borrow. And the income that they use to work that out is the rent. So if you go back, say a year, these stress rates might have been 3.5%. Effectively, they'd be using the 5-year fixed rate if you were taking one out to calculate how much they can lend you. Those stress test rates now are closer to 5.5, 6. So that has had a big impact on how much people can borrow. A property that you might have got 65, 70% loan to value on as a loan, now you're struggling to get to 45 or 50. So that's a big driver of A, what people can buy because the deposit's important, and B, what kind of rates they're looking to take out. Because again, without getting too technical, banks are allowed to lend you more if you take out a longer term fixed, 5 years or more, than if you take a short term fixed or a tracker. So one of our big expat lenders has two popular products, a 3-year tracker and a 5-year fixed. But for a lot of clients, they can't have the 3-year tracker because it just doesn't allow them to borrow enough money. So they have to take the 5-year fixed. And it's not a bad option for them. I think anyone who's a little bit stressed around budget probably should take a 5-year fix anyway. But this increase in interest rates and the way it's affected how much people can borrow because it affected the bank stress test is a big driver of how much people can borrow, what sort of budget they can then afford in terms of a purchase, and what kind of product they take out eventually, because a lot of them have to take a 5-year fix.
The stress test that you've mentioned, I remember having a chat with someone before about it. And I was saying, yes, but rents in this area, they're great. They've gone up so much. The percentage, the yield is great. And he was telling me, but Susana, it's about the area. We analyze the area and how much are we lending in that particular area. Is that how the banks check? Is it, or how is it done in specific? How does that affect then, let's say, an area that is booming and there's a lot of construction and a lot of buying? Do the lenders assess the risk for that particular area in terms of lending?
There's two ways which that can impact. Some lenders, it's not necessarily about areas, about developments. So they'll look at an individual developer and say, we don't want to own more than 5% of this development. Once they get to that level, they'll just stop lending on that development. That's quite hard to manage because they often don't know how far they've got. I've heard stories of lenders going over slightly before they've worked out exactly how much they've got. And they'll just pull down the drawbridge. They'll send out an email, we don't lend anymore on this. And it can even affect applications which are in flight and going through, and they'll suddenly just say, sorry, we can't advance this any further because it's never going to draw down because we've got too much here. So that's one potential impact. And we try and keep an eye on some of our bigger expat lenders who are quite good at sending alerts out when they can that they've stopped lending on a particular development. The other thing that can happen is that the surveyors will go out and they'll be very aware that there are going to be several dozen, maybe several hundred flats released at the same time in one development, let alone in one area. And so they won't value the rent up. They might believe that this property will eventually get to, say, £2,000 a month. But if there's a huge glut of properties released at the same time, there's going to be a price for it amongst those landlords. So they'll price it at $1,500. So I've seen that as well. So that's something to be aware of. It doesn't necessarily affect the long-term prospects of that property. I've seen examples where someone's had to cut their rent initially, but 2 or 3 years later, when you're doing the refinance, it's up nicely at the market value and it's gone up quite a lot. But the initial impact when they try and draw down a loan is that the surveyor believes the market's going to be flooded, for want of their expression. They'll like to reflect that in their valuation on the rent. And that's the valuation that the lender uses. So that affects how much they'll lend. It's so
interesting that you're saying that, because obviously as I deal with clients and buying in different developments, some are smaller, some are quite large, some will take quite a few years, sometimes even a decade to kind of have all the different blocks done, and they stagger the release. And it's funny because on Friday, I went with Freddie to see a few sites close to Dartford area from a developer in specific. And I was obviously part of the first development that was released, which the units were sold during the pandemic. So the prices were really appetizing. And the rents that we've estimated, which was based on a 5% yield, we've superseded that by a few hundreds of pounds more per month in terms of rent. So it's quite successful. So looking again for other stages where we can be at the forefront when the prices are good for the clients to obviously to buy. And when you've mentioned that about, it hit me with the staggering. And this developer, I remember being there on the first building, in the first unit that completed, looking across to the other one that was like halfway through it. And the sales lady was telling me, oh, this one we're holding back on. It's not going to be released yet. We don't know when it's going to happen. It's probably going to be finished, but they're not releasing it. So it does show, it kind of goes along with what you were saying. Now they've decided, okay, now we can release the development, so they will put it on the market for sale. But they've got several coming up. So I wonder if that's something they also take into account. If it's a huge development, obviously banks are lending on the first stage, second, and if it's throughout the years, trying to see how things work between both sides, developers and banks. Is there a communication between, or do you think the developers will suss out, okay, we've had potential lot of mortgages here, we need to hold back because maybe they won't lend so much on the next stage? Do you think that's a concern for them?
The key cog in the wheel here, so to speak, is a surveyor. The bank is taking the advice of an independent surveyor, and they have to do that for all sorts of reasons. Risk management, effectively. They want that person to be independent. Them, their auditors, their shareholders, that's a key driver for them. So the communication needs to be between the developer and the surveyor and a good agent. You'll be aware the surveyors will come and ask for your comparables, ask for market comment. So I guess communication is key there, and that means you need a developer who understands that, you need an agent who understands that, and you need a surveyor who's going to work with you. Unfortunately, that last one is not guaranteed. Some surveyors are stubborn, shall we say, to be polite, and they want to go into an area and make up their own mind. We have seen, especially during the pandemic actually, when, well, we know all sorts of services are stressed. You might get one example of a surveyor coming down from Norwich, which is a relatively small city, to value properties in East London and just didn't know the market, had no idea what was going on, wouldn't listen to anyone, and made some what looked like very bad calls in my respect. But the bank said, well, we instructed the national surveying firm, we trust them, we have to allow them to do their job. They found the nearest person they can to East London, who happened to be some guy from Norwich, and the result was predictable. So unfortunately, you don't always get all three of those things, but it definitely helps if you've got a good developer. You guys communicating as an agent and trying to communicate properly with the surveyor.
Going on to, obviously, mentioning Norwich, and with the spring budget, there's an incentive to invest in other areas outside London. There's obviously Greater Manchester, Liverpool, and a few others. Have you seen, or has there been, it's very early stages, I suppose, but these are areas of future development and that the government wants to grow. Do you think this will have an impact in terms of requests, in terms of mortgage? Have you seen any indication that clients, I don't want to go to London, I want to go to Manchester or Liverpool because maybe the yields there are higher, because obviously the price per square foot is so much cheaper? Have you seen that from your side?
We've seen Manchester be popular for probably a couple of years now. We have an advisor based in that part of the world as well, so we're quite tuned into the market there. And that's definitely been a popular area. Liverpool, maybe not quite as much. As you say, other areas need to catch up. But yes, clients are aware there are better yields to be had outside London. They are looking in those areas, Birmingham as well. Manchester, for some reason, seems to be the flavour of the last couple of years.
Wales mentioned as on.
Cardiff, yeah, I mean, student towns are often popular. You get slightly different. You're into the HMO market where people will try and develop properties that can be occupied by students. You take a 3-bedroom house and you turn the lounge into another bedroom, and suddenly you've got a 4-bedroom house, and you can increase your yield by letting it to students. So, yeah, student towns, and Cardiff is definitely one of those. Are popular from that point of view. In terms of new build property, Manchester seems to be leading the way from our point of view anyway at the moment.
There's an indication that there's been a slight growth in terms of buying properties, but on a larger scale in terms of bigger units. Do you have the experience in terms of clients, okay, I want to buy this property? I couldn't necessarily say because they're buying something bigger, that means it's more expensive. But have you seen that sort of happening from your end? Someone buying a 3-bed instead of maybe buying a 2-bed or a bigger house?
In terms of clients looking to accommodate students in HMOs or houses of multiple occupation, yep, absolutely. It is a fairly established track that now to getting higher yields and buying in a town that is booming. You get it right, you can get both. Student towns do tend to experience some sort of capital growth, especially the student population can be persuaded to stay on and contribute to the economy after they've graduated. So you'll get the yield while they're students and you'll get capital growth because you're holding bricks and mortar in a popular location. I think Manchester is sort of ticking the box there. It's, I believe, one of the biggest student populations in the country, and it is a sort of thriving city. And so people think they might get both there.
We have a few clients that did buy sort of in those pocket areas, and it tends to accommodate students. Back in my days of doing property management, I used to have a landlord alone with between 15 to 20 units just in Nottingham.
Okay.
And it was
yes.
all students,
Yeah.
all students based.
That's right.
Not the easiest to manage.
Definitely not, no.
But he did have very good returns. I see clients now going back to, especially investors, buying 1-beds. At some point, I had the question, Susana, what is the best type of unit to buy during the pandemic? Because we had clients looking for the extra space to work from home. The couples need an extra room. You know how it is here in the city. Most of the kitchens and lounges are open space. If you're working together or you have a kid, not to say more than one, it becomes extremely difficult if you just have a 2-bed flat with an open plan to work from home. So we saw that change of investing instead of 1-beds going to 2-beds. It became a preference, but now I see a request from clients going again to 1-beds. I'm wondering if there could be, again, because of rates, mortgages, finance, in terms of what their budget is. What is your experience in terms of clients? Because I've seen the shift from 1-bed to 2-bed and now 2-bed going to 1-bed. Obviously, they get finance from somewhere. Have you experienced that, or is just, at the end of the day, it's just budget?
I think a lot of that is budget. Going to what we were talking about previously, because the stress test has increased so much, the deposit you need percentage-wise is usually increased on most properties. So that means that landlords are having to say, well, I can't afford that 2-bed anymore because I've only got X amount for a deposit. I'm going to have to go for a 1-bed. If I have to put down a 45% deposit, it's going to be a 1-bed rather than a 2-bed. But I also think rents have gone up a lot in London over the last year or so or longer. You'll know that better than I do. And perhaps tenants are thinking, I can't afford that extra bedroom just so I don't have to work in a room with my partner, or I'm just going to take the 1-bed. And it is an old adage, isn't there, that 1-beds can be let to 2 people, it can be let to 1 person, so there's a bit more of a market there. But I suspect it's tenants as much as anything else driving that. The luxury of saying, well, I need the extra space, it's just not possible anymore. Comes down to budget again, I suppose. There are people thinking, oh, might have wanted a 2-bed 2 years ago, but now I can only afford a 1-bed, so I'm going to take the 1-bed. Which means demand for 1-beds is increasing.
I've got a question about the clients who have remortgaged, have sort of moved outside the city. I used to say during the pandemic, I've decided to stay in London as well. I didn't move out because at the biggest reason for people to leave was more space so they could juggle working from home and everything. But the pandemic was not here to last forever. So I thought, okay, I'll give it 3 years. Whoever goes are going to remortgage, and then what they're going to do when the city opens up again, theaters are open, cafes, the buzz is back on, which is what is so great about the city, being there, London or Manchester or Liverpool, whatever it may be. Do you think there'll be, again, a reassessment? Because obviously some clients will have gone for 3-year rates or 5-year rates to then maybe try and come back to the city, because then they'll obviously have bought outside. What are they going to do with those properties? Are they going to sell? Because prices have gone up outside London just because of that, because they were so much cheaper and there was a higher demand. But now I see a few starting to come up, and that 3 years that I was saying to some of my friends, you're going to get bored in the countryside. Do you think people will start to reassess again their finances to potentially come closer, or do you think they'll just settle where they are because of the type of mortgage they've got into?
A good question. I mean, we are seeing, there was some press a week or two ago about people who regret leaving London and want to move back, but that's difficult. I did have a client, this was before the pandemic, who'd bought in Yorkshire and wanted to move back, and they just couldn't make it work. They paid a lot of money in stamp duty. They'd bought a property in Yorkshire that wasn't going up in value. Everything they wanted in London was going up by 5-10% a year. And they found it very, very difficult to get back. So maybe people might want to come back, but whether they can, if they spent a good chunk of money on stamp duty, probably going to have to spend more to come back to London. And if they're stuck in that cycle that where they bought isn't going up anymore, but London properties are, that's going to be very difficult.
If things are stabilizing in the city, which we say that the mortgage rates are getting better, throughout the time, things are stabilizing. There is investment. There is opportunities here. What would you say to those who have, let's say, some money saved and they're thinking of investing? Would you say go and look for something here? Or what would your advice be if someone is thinking, oh, I'm going to get an ISA for this or investment for that? Obviously, I'm biased because I'll always say bricks are always a good investment. You just have to look carefully and make an educated decision. What is your point of view for someone who's on the sidelines, go, not go, especially if it's an expat abroad looking into London, Hong Kong? They're so well organized. They have everything working so smoothly most of the time. What would you say to those clients that are a bit uncertain, but they have the funds?
It's a very personal decision. It isn't just about buying an asset or an investment. You are buying what's going to be someone's home. I think you have to sort of enjoy that responsibility. I am a landlord myself, and I have 2 properties, and I enjoy that aspect of it. I enjoy getting to know my tenants and having the responsibility of providing a home for them. As you all know, it's got harder in recent years. It isn't just about the mortgage cost. There's tax implications that may or may not affect people from overseas, and there's a lot of regulation as well. So I think you have to be prepared that this is a different type of investment. It can be very lucrative and it can be great fun and very rewarding, but it's different. So it's a very personal decision. And if you've got a passion for property and you enjoy dealing with people and you enjoy that responsibility, then why not? Because it could both be very enjoyable and very lucrative.
Question to you, how are your rents performing?
Very well. Very well. One of them went up quite spectacularly recently. I cut it a bit in the pandemic because, again, I had a relationship with my tenants. I wanted to help them out at a time that I felt we should all be helping each other, and I reversed that and sort of added the same again. So, yeah, they're performing very well.
Good. We've seen here, obviously, huge increase in rents all the way until beginning of the year. They are sort of becoming a bit more, it's still higher, but it's not the craze that we've had. I think it's becoming a bit more seasoned. And I think a lot of clients tenants in particular, will welcome that. We've had bidding wars over the phone without seeing units because they were going so fast. Obviously, we've been always very cautious with clients and even educating them to say, you need to go and see a property. I've mentioned this before with other colleagues, because they just wanted to offer to get the property even without seeing it. Otherwise, you would be gone and wouldn't find something else or get into a bidding war with someone else. I think through the industry, for us here, we have been cautious on not getting clients to overbid each other. Go through one offer at a time. They tend to be good anyway, and educate also landlords that through the pandemic, if you had a steady rent, maybe now just reconsider how your rent is performing versus open market versus what is the increase, and make a more conscious decision of maybe keep the tenants that you have, keep your costs restricted to, let's say, not paying for the checkout or paying for an inventory or cleaning or all of those things that you have to do when you have a tenant sort of notice because maybe the rent has not increased the 15% or 20% that you've expected. But on the long run, if you think about serving notice and then having someone move in fresh, but what you have to pay for someone to move in, maybe sometimes it's not that great. So we've been trying here from our side to educate the landlords that we work with that what you hear in the grapevine of these huge increases has to be considered how it performed during COVID versus now, and maybe remarketing is a good option if it's a massive difference, but maybe it could be keeping the tenants as well if it's that close and keeping the costs. From your side, obviously, you've mentioned that you've had a good increase. Have you seen the other side of, okay, maybe I have to reconsider on serving notice on my tenants for a better rent, my mortgage, maybe you have a good mortgage, rates have gone up. Have you experienced that, or do you have other people that you know that have that had to make that assessment of cutting with the tenant to kind of get more rent?
I agree with you. I would probably never do that unless I felt they were paying way below market and refusing to negotiate with me. I've been a landlord now for 17, 18 years, and I've only put rent up on existing tenants twice. And that's because they've been there for a very long time and they were happy to have that discussion. But I'm very much a bird in the hand sort of when it comes to tenants. If I've got good tenants who pay their rent and behave well, basically treat the property well and don't give me too many problems, then that's worth its weight in gold as far as I'm concerned. Property is a long-term game, so if someone's paying me a fair rent and looking after the property and paying me on time, then I'm very happy with that.
Very happy.
Yeah.
It's a good formula.
Yeah, I think you've got to be pragmatic, and it is their home. They will look after it if you treat them well.
After all this and all the advice that you've given, the information that you've given us, which has been brilliant, I hear that you have been nominated for 3 awards. Care to elaborate on the awards?
We have, yes, thank you very much. We've been nominated for 3 awards: Best Broker Under 8 Advisors, Diversity and Inclusion Broker Champion, and Best Broker for Technology and Innovation.
That's fantastic. Maybe the formula is to start just before the pandemic, strategize, and then...
Yeah, I mean, definitely the pandemic formed part of our strategy, and it probably helped with all 3 of those awards. So yes, you've got to make the most of adversity and opportunities, and this is good testament that we managed to do that just after 4 years of being established.
Fantastic. Well done. Congratulations on your awards. I'm sure it's well deserved. It's been an absolute pleasure having you here today and being able to ask so many questions. I would have far more, but I think we've spent so much time already talking about amazing topics regarding property, mortgage. It's been really, really, really nice to chat with you. Thank you very much.
Very nice to meet you. It's been my pleasure. Thank you.